All right, good afternoon, everybody. Thank you for joining us here. It is 1 o'clock. I'm going to go ahead and get things kicked off. And for those of you who are joining, I just gave a heads up that I'm a little bit ahead of everybody. So by the time you see these slides change and you hear me, I am actually a little bit ahead of you as well. But just a few things to note. My name is Chad Peterson. I am an underwriter for West Bend's monoline work comp division. We go by the name of Argent, but by and large, we're all part of the same big West Bend family. So thank you for joining us this afternoon. I know you all have very busy schedules, so I appreciate the time that you're taking here to learn about one I would consider one of the most important factors as it relates to work comp insurance, and that is the experience modification factor. I do have Jason Schaffenbuhl on board here as well, who I believe had sent you the invitation for this presentation as well. One quick ground rule, we do have the audio and microphone features turned off for this presentation, but we do have the chat going here as well that you might see over on the right-hand side. So handouts are available between the chat window and where you type. So you can click over there. Again, that's on the right-hand side. If you want to maximize your window, you can do that as well. And the way you do that is there's a little red box with 3 vertical dots in there. You can click that and that'll push your chat off to the side, and that will allow you to get into a larger window if you so choose, depending on your screen size there. So with that said, I'm going to go ahead and jump right in here. I'll try and keep an eye on the chat as best as I can, but realistically, I'm going to end up probably just having to go back through at the end of the presentation and cycle back here because I'm going to be kind of flipping between. I've got 2 monitors running on my side here, so between presenting and trying to keep an eye on things, I may not catch all questions or inquiries as they come in. So let's go ahead and dive right in. So this is what I hope to cover in this afternoon's presentation. I'm really going to give you an idea of what we look for from an underwriting perspective. So when we do have accounts on our own, whether we are renewing or taking in new business, as well as taking a look at the experience modification rating itself, what exactly it is, what it isn't, and what it means to you in your role at your business. We'll dig into the experience mod worksheet. So everything that goes into the experience mod, all the content of it. Now, I'm not going to get in too detailed information, but just to give you an idea of what you might be looking for if you haven't seen one of those before. Statistical reporting, that is all of the nitty-gritty details that do go into the calculation of the mod. The life cycle of the experience mod, so basically what is all over a frame of time, what is all factored into the mod calculation, what that means to premium, how those dollars figure into your work comp premium at the end of the day, and we'll also go over a few sample scenarios as well. So just some quick guidelines on underwriting principles. Each carrier approaches work comp differently, so the way we do things are going to be different, how others do things. But here's some insight into the basic point that we evaluate when we are underwriting policies. So management attitude is number 1, you see there at the top. So management and ownership attitude is everything to us. Is employee safety a priority? Is the carrier viewed as a partner and a resource in the relationship? Is there a willingness to cooperate with a carrier to address safety concerns that come up in loss control visitations? Or is it just a matter of trying to get a feel for what the relationship looks like? Return to work and modified duty, and I'll get into that a little bit more detail later on, but really what we're looking for is whether or not there's still a desire or a means to keep employees working after they've been injured. And again, we'll get into the importance of return to work and modified light duty in future slides. We are looking for insureds who are looking to partner with a carrier to lower their insurance costs over the long term, over the course of 3+ years, and to drive their experience modification factor down. In that regard, everybody wins. And so this isn't, where we're just looking for an account to pick up for a year or two here and then let them go on their way. And we would be looking for someone who's seeking a carrier in that same light to join it with us and have a partnership as we look to drive down and make the workplace a safer place. We do have the capacity to write exposure in all 50 states, but we really emphasize focusing payroll and exposure to our what we call core states that are listed out here, and we are kind of slowly branching out into different states as time goes on. But right here, what you see there, those handful of states are what we would consider our core states, because that's where we have claims expertise, that's where we have loss control boots on the ground, and if we exceed that 20% outside of our core states, we know that we won't be able to provide the level of service that we know we're capable of, and that would just be a disservice to any insured who would find themselves in that kind of situation. And then last but not least, really we're looking for trends. We understand that surprises and unexpected events happen, and we take that into consideration when we are evaluating a renewal or new business account. But that's what insurance is here for. But are we seeing the same outcomes year after year, good or bad? Is there any trending that we can discern in the loss runs that we review? Other underwriting factors that we take into consideration, so sticking with the trends theme, we're going to be looking at the large losses versus the frequency of losses. We're looking for any patterns, if any, whether the losses an account is experiencing can be something our loss control team can help engineer or mitigate. And like safe patient handling, machine guarding, ergonomics, slip, trip, fall hazard, so on and so forth. So is there a common cause to the losses that a business is seeing? Is there a lot of slip, trip, falls? Why is that happening? Are there repeat claimants? Do the same 2 or 3 people keep showing up in loss runs, and are they having expensive claims? Well, what's going on with that? That's an anomaly in our eyes that we would want to learn a little bit more about. We do evaluate 5 years of losses and payroll data because that helps us capture and get an idea of those trends. When it comes to class of business, we take that into consideration as well. So obviously, each business is created differently and each has their own business segment. So whether it's contracting, manufacturing, transportation, healthcare, is it operations that we're familiar with? Anything known to have high-risk activities like foundries or dynamite manufacturing or firefighting, anything like that? If it's something that we're not familiar with, and we just aren't really going to be, we're not going to feel comfortable being able to advise the way that we know that we should be. And then payroll trends. Is a company growing or shrinking? Are they expanding? Are they acquiring other businesses? That's going to be important to help gauge the longevity of a relationship that we can have with an account. This will give you a little peek behind the curtain as to how insurance carriers compete. So there's a lot of different carriers out there, and then we need to do our best to set ourselves apart from each other when we are competing for business. One way that that's done is through value-added services. So some carriers offer coverage with little to no regard for customer service or provisions to enhance safety measures and performance. This is where you'll find your lowest pricing options. They can get away with having such a low price because they aren't going to offer much for loss control services or claims handling or maybe a nurse triage service. On the flip side, carriers like West Bend or Argent, we have a model in place which puts customer needs first with dedicated claims representatives, loss control services. Loss control services are utilized on an as-needed basis. And in order to offer the level of service that we do, we end up having to charge a little bit more premium than if we were not providing that same level of attention. However, we offer the best service for the best price, and those savings are realized in the long term. And you'll hear me speak throughout this presentation just how much a relationship means to us. We want accounts to be staying with us year after year, not coming in and out or just looking for the lowest possible premium on any given year and then leave us. Another way that carriers compete is kind of on the backside of a policy. So that's with dividends. Here in Wisconsin, we do have what are called flat or fixed dividends, where that's a set amount of premium that's returned to an account at the policy expiration and after the payrolls have been audited and everything. So for example, a $100,000 account on a 10% flat dividend would receive $10,000 back after that completion of the audit. Alternatively, there is a variable or sliding scale dividend plan. We offer that in many of our other states. That is where performance dictates return on dividend. So depending if you have a lot of losses, you may not get any money back, or if you have very few lost dollars, you end up, basically the better an account performs, the more money that they'll get back on the dividend. And there's also a combination available as well in Wisconsin that we would be able to implement and try to win business in that manner. When it comes to, we can also actually manipulate rates, or at least file for different rates, and that's through something called loss cost multipliers. And each of these are taken care of at a state level. So a rate that carriers can file for to apply a state manual rates is known as either just rate filing or loss cost multipliers, as I mentioned before. So if a carrier feels that they can't be successful with the manual rates that a given state has set forth within the course of a year, they'll apply for a multiplier. Sometimes that's less than what the state came out with or more than what the state came out with. So if a state says that someone in a clerical position has a rate of $1 and the carrier says, well, we think we need to have 5% more than that, or 10% or 15% more, they'll file for a rate that's whatever set amount above what the state came out with. And that is in an effort to maintain that individual carrier's business approach. And I know I'm getting into the weeds here a little bit, but I just want to give you a little bit of insight into some of the pricing factors that need to be taken into account as we are working on various businesses. On that loss cost multiplier, so that is applied to all rates for that state. Carriers can't just cherry pick on which class codes or which rates they want to drive up or drive down. But there is a way to alter pricing on an account basis, and that's through scheduled debits and credits. And again, some states have it, some states don't. Wisconsin does not, but that's where those flat dividends come into play. Iowa certainly uses those a lot, and that can be applied, as I said, to individual accounts. So there is some discretion in that regard. Now to get into the bulk of what we were hoping to cover here today, and that is to hopefully what draw you in here today, in fact, how you can lower your workers' compensation premium, and that is through something called the experience modification factor. In short, it acts as like a report card or a running GPA for your insured. It's a number that is used as a more or less a barometer to show how someone's safety performance is. And I have here that it's a 3-year snapshot of a company's safety performance based on historical loss experience and payroll within a given industry. And what I mean by that is when we are, I shouldn't say we, but when the state bureaus are comparing one company to another, they need to make sure that they're doing it to the industry peers. So each job shown here is different from the others. Therefore, it's unfair to compare them to each other to gauge that performance. It only makes sense to compare these companies with similar operations. So the exposures associated with pipe fitting are going to be different than those associated with roofing, are going to be different than those associated with working in a nursing home, are going to be different than those associated with working in a machine shop. So you kind of get to see that. Then you break it down into account size. So some accounts are huge and they have much more exposure, and much are much smaller and have far less exposure, and that's taken into account when the experience modification is being generated. So again, it's really just a method for tailoring work comp costs and insurance coverage to an individual business. And these modification factors, as they're called, or just MOD, as we call them for short, are produced by various bureaus throughout the nation, the most prominent one being the National Council for Compensation Insurance, NCCI for short. There's also state-specific bureaus like the Wisconsin Compensation Rating Bureau, or WCRB. Pennsylvania has the PCRB, and it really is all dependent on where you are at each state. So NCCI currently serves 36 states, and the overarching theme here is that NCCI and the state bureaus are who we, the carrier, answer to on work comp related matters. So they provide oversight for all the carriers to make sure that we're playing by the same rules. That's not to say that carriers don't have some freedom or choice to operate how they want, but these bureaus lay the foundation to make sure everybody's kind of playing by the same rules and what is or is not allowable. This is just a map of which bureaus are responsible for which states. So the blue-green color here representative of the states that are assigned to NCCI. Then the peach-colored states are those who have independent bureaus, and then the orange being the states that have monopolistic cover. They're a monopolistic state, so the state government is responsible for workers' compensation coverage in those 4 states. So we'll dive right in a little bit more here and get into a bit more detail in taking a look at what exactly the experience rating is. So in short, it basically compares actual losses incurred to expected losses. So they're taking a ratio of the company's incurred losses versus what the actuaries at these state bureaus would basically project or expect for that particular account, where incurred in this case means dollars that have already been paid, as well as those that are in reserves or waiting to be paid, or that the claims adjuster anticipates to be paid in the course of that claim. So what determines what expected losses would be? As I mentioned before, I referred to the actuaries. So all claims information rolls up to each of the bureaus that I mentioned, and their actuaries aggregate that data to determine what a reasonable amount of lost dollars would look like for a specific account in a given year within a specific industry. So a mod of 1 is considered average. That would be the benchmark by which any business is measured against. And so when actual losses are less than what would be expected, that results in a lower mod, or a mod of under 1. That's very favorable to an account because you're paying less than the average, or you're paying less premium than your peers. On the other side of that, you have actual loss. If the actual losses are greater than the expected losses, you'll have a higher mod, and that is above a 1.0, and that's unfavorable for a business because you end up spending more than what you should be as a result of the claims and losses that you have experienced over the 3 years that fit into the experience modification factor. Some carriers use an experience modification factor as a metric to determine whether or not they would pursue an account or whether or not they would write an account. Not us. We evaluate accounts on their own merits, mainly on the items that we discussed earlier in the presentation between attitude, cooperation, return to work, and so on. But we're comfortable with high mods or low mods. It doesn't necessarily make a difference to us. If it's the right partnership, it's the right partnership, and there isn't necessarily it's not like an account can zero out their mod, and on the other hand too, there's not like a max for accounts either. The lowest mod factors that I've seen are typically maybe like a 0.6, maybe 0.56, something like that. But like I said, it's not possible to zero out even with $0. And then on the other side of that too, I've seen mods as high as 4, some 2.0, 2.26. So they're kind of all over the place. But as I said, if we're willing to work with each other, we could. It's definitely a possibility, and that's what we look for our partnerships. There are also what is called primary and excess losses, or a split point factor. I'll get into that more right now. So primary losses observe the claim frequency or the first $16,500 of a claim. Again, using Wisconsin here as an example, as that's where a lot of our accounts are located. But this varies from state to state, so that you can take that $16,500 and it would be a little different for each state. But again, primary loss is really focusing on the frequency, and then excess losses looking to normalize the claim severity or anything above $16,500 in this case in Wisconsin. So it's worth noting too that the larger the employer, the more its mod calculation is influenced by its own experience. And the examples that I have here are that say you have one claim at $5,000. The primary loss in that case is $5,000 and nothing in excess because it didn't pierce that $16,500 mark. Contrarily, if you have a $36,000 claim, $16,500 will max out the primary losses, and then the excess loss amount is $19,500. And so the next bullet point down demonstrates that the primary losses are applied at the full weight in a mod calculation. The excess losses are given partial weight, and the amount of that partial weight is determined by the size of the account. So any debit or credit mods, whether they're above or below a 1.0, is influenced by their own performance and an account's given size. The example that I have here, an employer with 10 losses at $5,000 each is going to have a slightly higher mod than what an employer would who has one loss of $50,000. So it's the same amount of lost dollars, but the one loss at $50,000 had a primary loss of $16,500 and the rest went to excess, whereas the other employer of similar operations and size with 10 losses at $5,000 also had $50,000 in losses, but every one of those went in as primary losses, if that makes sense. So another way that accounts can be protected in the instance of large losses is when there's a cap or a per claim accident limitation, and that is a cap that's placed on individual claim amounts to prevent any adverse impact from any single large claim could have on the mod for an account. And those values are determined by each state. These are what those levels are for each of these states listed. And I just have a handful here. We can go in and take a look, or you can ask your underwriter as well, or your independent agent to find out what it is in a given state. But the example being, say there's a $500,000 loss. In Wisconsin, only $241,000 of those dollars are counted on the mod. In Iowa, $301,000 are counted. So in the unfortunate event, there's a $3 million loss on an account, wherever it may be, on that for that one individual or that one particular claim. Yeah, it gets to be an expensive claim, but the account is only impacted up to this point on their experience modification calculation. Well, and here, You can get out your abacuses and slide rules just when you thought you wouldn't have to worry about order of operations anymore. Here, the equation itself rears its ugly head. So if you want to crunch some numbers on your own, this is the formula by which you would be able to determine your own mod. Each of the variables there are listed out, and I'll show you on the next slide what where each of those are pulling from on your experience modification worksheet. And that's what we have here. These are the components of an experience mod. So here's a look at a part of an actual mod worksheet. So this is what I, the underwriter, or your agent, and even you accounts see. This is an experience modification worksheet, and it's from NCCI, as you can see up there in the upper left-hand corner. But I've called out a few things here, so you can see the letters here in the red circles. That's what's part of used in the formula from the previous slide. I'll back up real quick, and that is again where those red circles are plugged into that formula. The expected and actual losses are called out on here as well. That's been called out in the yellow boxes at the top. So that is the greatest factor in determining the final mod number. Now, it's not the only thing that'll determine the mod, but that's, again, where they're comparing the actual losses that an account had compared to what would have been expected by the Bureau. And then down there at the bottom, the yellow box down there at the bottom lower right is the mod factor. It's as simple as that. So in this case, it's 0.79 for this account. So they've performed well over the years and are paying less than what their peers would be of similar size and operations. Here again gets into the details pages of the experience modification worksheet. And I know it's a lot to take in, and I'll just give you some landmarks to work with here as well. So and I've got it color coded. So in the blue circle, you have the listing of class codes. So for those of you that don't know, every job out there is assigned to a particular class code. So your job, my job, any workplace position is assigned a class code by the Bureau. And that's how they tabulate the amount of payroll and losses that are incurred in any given line of work. Again, that's in the blue circle. There in the red, you have the total payrolls within a given policy period. In the orange yellow circle, those are the claim numbers. So anytime somebody has a claim, again, it will get filed up with the Bureau, and each claim is listed on the mod worksheet. And you can see there then the impact that it has to the right of those dollar figures, the numbers that are used for the calculation of the mod. Green circle in the lower right is the actual incurred losses, and the darker blue circle is representative of the injury code. So each injury is coded a certain way, and it's 1 through 9 that you can see there. By rule of thumb, 6 is good. Those we know are medical only losses, but then 5s and 9s we know are indemnity losses, where we did pay out on, or the carrier did end up paying out on the lost time wages. More to come on that. This is a mod worksheet from the WCRB, the Wisconsin Work Comp Rating Bureau. Yellow and red are representative of indemnity losses, and then those are the 5 and 9 injury codes, and then the number 6 injury codes there in the white would be medical only losses, and then in the blue shaded boxes are just where the policy totals are tabulated there again. So this slide and the content herein and in the next couple slides here may be the most important takeaway for you and for your business, and that is the difference between medical-only claims and indemnity claims. So indemnity meaning that we are paying for a worker's time off of work as a result of their injury to make them whole, and medical-only meaning we're only paying for the medical-related expenses, whether that's a doctor visit, an MRI, surgery, just the pure medical expenses. In an ideal world, we wouldn't have anyone off of work. They'd get injured, treated, and back to work with accommodations right away. And the reason that I say this is such a significant part of determining an experience mod and therefore premium is that with medical-only claims, lost dollars are discounted by 70%. We gave a simple example here of a $1,000 claim only has an impact of $300 in the calculation of the mod. Obviously, that is a lesser impact on the mod factor. It's a reduced amount. Whereas indemnity claims, again, where somebody's being paid to be off work, those lost dollars are fully applied to the calculation of the mod. As soon as $1 of indemnity is paid, the full claim amount is considered indemnity and 100% is applied to the mod calculation. And that therefore has a much greater impact on the modification factor. So the take-home message being, anytime there is a claim, you want to do your best to make it a medical-only claim. You don't want that to turn into an indemnity claim where there are lost time dollars associated with that. And the way that you can do that is through return to work and modified light duty programs. So when your loss control representative or your claims representative starts to they want to help you develop these programs, you've got something in place. You're in a much better position to be proactive in that regard than you are reactive, to have something lined up. If you have a list of tasks for someone to do, depending on what the injury is, if it's sedentary, maybe the person has to be seated for 8 hours and they can't lift X number of pounds or whatever it is. If you get together with your loss control representative to come up with a list of different activities for injured individuals to do, that will definitely help put you in a good position to ensure that those lost dollars don't become indemnity dollars. And each state has a waiting period after an injury occurs. You should be offering light duty to that injured individual before the end of the waiting period. Some states it's 3 days, some states it's 7 days. Again, the best advice that I can give you is that you would get in touch with your claims representative shortly after that. Well, file the claim as soon as possible, and then your claims rep will be in touch shortly thereafter and work with them, ask them, can we keep this as medical only? What would be the best way to ensure that we keep this as medical only, and to work with them on that front. And I can give you an example here of exactly what I'm talking about. Some real, this is a, I just saw your message, Randy. Sorry. This is a real life example. This is what happened on one of my accounts. So the comparison between the medical only and indemnity impact with real dollars. So the indemnity, the top half of the slide here is representative of what actually happened in this case. So it was indemnity dollars. The incurred loss was $8,261, 7,106 of which was medical, and then the indemnity dollars amounted to 1,155. So we were paying the employee's wage, 2/3 of the employee's wages, to amount to $1,155. If you follow that to the right, the blue box on the right there, the impact that had on this insured's premium was just over $9,000 per year that they ended up having to pay because they wanted us to pay that $1,155. So over the course of 3 years, they end up paying $27,000. And the story was, let's just say this was a roofer making a higher wage, and you know, they would have rather had the employees stay at home and watch you know, lawyer commercials and let Argent or let the work comp pay 2/3 of his salary than to bring him in and pay his full wages for doing something that didn't align with typical job duties. So again, for the sake of example, let's say it was a roofer, and rather than having him come in and sweep floors or perform data entry or whatever the case might be and still make that higher wage, they said, yeah, no, just go ahead and pay the $1,155. And then, like I say, they ended up paying over $27,000 as a result over those 3 years. However, if they just brought him in to stare at the wall, or not literally, but paid him his normal wages to do light duty or modified light duty, they would have paid $1,732. So going down to the bottom half of that slide, this is what could have happened if they had listened to our recommendations from our loss control representatives and our claims representatives. So again, under incurred losses, you see the $7,106. That's what Argent would end up paying out. And then on the limited and adjusted losses, right next to that, you have $2,132, which is 30% of the $7,100. So that $2,000 is what goes into the mod calculation rather than the $8,000 that you see above. So again, follow that all the way over to the right. Over the course of 3 years, the insured ended up paying $7,000 instead of $27,000, or would have ended up paying $7,000 instead of $27,000. So I know it's kind of a lot to take in, but it's just, I can't emphasize that enough to really just drive the point home that to try and keep these as medical only costs and what that'll do for you and your company. Again, reach out to the claim rep, reach out to your loss control reps, and find ways to ensure that things stay in medical only. Oh, and Jason, right? Had they kept, and I get a separate message here, but yes, had they kept the employee working rather than sending him home to, as I say, watch attorneys' commercials, they would be paying $27,000 more. And understandably, some injuries are so severe that they're inevitably going to have lost time. I mean, not every claim can be made medical only, but here again, the claim rep would be able to help contain those costs from getting out of control, even when there is an indemnity situation. So, in the event that there's no way to avoid an indemnity claim, there is a way to keep those dollars down. It's not necessarily that all is lost and you should lose sleep at night, but definitely work with the claim rep to help keep those costs down. I'm not going to spend too much time on this next part. This is the unit statistical report, which basically is just everything that contains the elements for calculating the experience modification factor. And this is the information that gets transmitted up to the respective bureaus to include the payroll, class codes, claims information, dollars incurred. Carriers have entire teams of people who are responsible for this work. Everything is transmitted electronically. We're in 2020, so obviously everything is done online now. But if you were to see a physical unit statistical card, this is what it would look like. So I give you some landmarks again to help you see what we're looking at. The blue box on the left contains class code information and rate information. The 2 boxes on the right have specific claim information. So again, this would be in regard to just having the details, I guess you might say, for each and every individual bit of loss information that they have there. Let's see. Oh, and then when the information is reported to the bureaus, so in the case of NCCI and some of the other states, it gets reported 6 months after policy expiration. So here we are in August, coming up on September. If you look in the middle column and find August, that's the second box down. Information through this month will be reported in September for accounts that are effective in February. Similarly, the accounts that are going to come effective here in September, looking at that left-hand column, so find September in that left-hand column, their experience mod information will contain loss information through this past March, which was reported back in April. So there's a little bit of hurdling that goes on, but that's to give you an idea of just how far in advance these numbers are calculated. We do get that some corrections sometimes need to be made. I mean, mistakes do happen, but there are other instances like we have in the bullet points here for what may cause claims to change, maybe especially if they go downward. So maybe we recovered a bunch of money on subrogation. That'll drive a claim down and that'll lower the mod. Sometimes claims become non-compensable if whether the medical or indemnity reserves zero out, depending on the circumstances. That'll drive claims dollars down, therefore the mod will come down. There is a 5-year reach back with NCCI states, depending on just how long and drawn out a particular claim is going on for. And then there is also what is called aggravated inequity. So that is what you'll find in Wisconsin and Michigan. That is proactive unit stat filing. So if a claim closes out at a lesser amount than what was previously reported within that 6 to 7 month window that we saw in the last slide, West Bend and Argent, we just automatically file the new unit stat card. And again, we're only able to do that in Wisconsin and Michigan. The other states don't allow us to do that, but that's aggravated inequity. And that's just a nice perk that we offer. Other carriers need to be prodded in order to file them. So either your agent has to reach out, or you have to reach out to the agent, and then they have to go to the carrier and say, hey, it looks like this claim closed out for less than what we thought it would. Can you go ahead and refile that? That doesn't happen at West Bend because we just do it automatically. And it protects only on the downside for your benefit. Next couple of slides here, I have demonstrated the, again, real life impact of lost dollars on premium, or how much a mod can impact premium. Just took a sample account here. In the middle of the slide there, you see the class codes, the class description, and then the payroll associated multiplied by the rate to get the estimated premium for the account. The top red circle there is a representative of the experience modification at a 1, so average. And then you drop down there to the bottom, work your way through the premium algorithm to arrive at a premium of just over $100,000. So just make a note of that. Again, mod of 1 translating to a premium of just about $100,000 for this account. Then if that same account, if everything else remains the same, except you change the experience modification factor, again, you can see everything stayed the same as it was from the last one, but that experience mod is now a 1.25. Drop down there to the bottom, that has a premium impact, and suddenly the premium jumps up to $126,000. So higher mod, more premium as a result. Same thing is true to the other direction. So if you have a mod below 1, in this case, mod in this example is 0.75, everything else remains the same, drop down to the bottom, premium comes to $76,000. So you can see just how much of a swing there can be in premium dollars depending on where your experience modification lies. We should take into account the life cycle of the experience mod, and as I've been mentioning all along here, that's a 3-year window essentially, and that's 3 years of the most recently completed policy years. So the example that I'll give here is that a mod that's effective in 2020 contains loss information from 1819, 1718, and 1617. Then coming up here in 2021, the mod will drop the information it'll drop the oldest information off of 2016 and bring in new data from 2019-20. So you'll have 1920, 1819, 1718. And I see my error there is 2028. Disregard that. That's a typographical error. It's 1718. But the numbers fluctuate from year to year, and this is why. So here's a look at the mod for I put together some arbitrary numbers here, but in this case, a mod in 2020. This is the 5-year window that we would look at as an underwriter to take a look at different losses, claims information, so on and so forth. Over there in the highlighted yellow boxes then are what would be captured in the mod. So those are the payroll dollars, the loss dollars that would be used to determine the mod. If we take the same information and jump to 2021, you'll see there that the boxes, that the red boxes drop down a year. So 1617 fell off and 1920 came on, and the mod factor is higher at renewal. And I'll back up here again to just show you what happened. So $6,000 came off in 1617 and 21,785 came onto the experience modification factor. So again, that is what will drive that up. Again, to consider the opposite side of things, in this case, you have in 2016-17, let's say there were $328,000 in losses from 5 claims. And then we're going to fast forward to 2021. You'll have $21,785 coming on. So the mod will go down then in that case. Again, the 328 fell off and 21,000, almost 22,000 came on. So that is a favorable move for that particular insured. Additional considerations, is there anything that we can take into account as an exception to justify our approach? So can we argue with the numbers? Yes, absolutely. So when we're looking at injury codes 5s versus 6s, again, 5 or 9 for that matter being indemnity loss dollars as opposed to 6s on the mod, what is that telling us? Is there a reason why there's so many indemnity loss dollars rather than the medical only loss dollars? Does there need to be a change in philosophy? Is it a matter of trying to come up with a program that allows the insured to get people back on light duty or return to work programs? Or is it bullheadedness where a business owner is just saying they don't understand how they can save these dollars, and they're just saying, yeah, no, let so-and-so stay at home and let the work comp pay their salary until they're ready to come back. We get some of that too. Then also, as I said earlier, we understand that large losses happen. You might have somebody who has, they slip and fall on ice and have, they have to have their shoulder replaced or their knee replaced or whatever the case might be, or if they're driving, if there's a motor vehicle accident that results in a significant injury. We know that stuff happens, and if it's not conditional to their other losses, we definitely understand that there's a story to be told there, and we take that into consideration as well. Payroll increases and decreases, again, is the business growing? Are they shrinking? We want to better understand what the impact will be in the long-term relationship. So what I'm trying to say is that at West Bend, we're not robots. We listen to a story, we look for trends, we assess each account based on their own performance, and we want to really dig into what we might be able to do to help folks out. So what is information without data to back it up? We have been monitoring our performance with our insureds since the earliest years that we have been around, at Argent anyway. So again, this information is specific to Argent. What you're looking at is what we call the class of mod reductions. So each colored table there is representative of accounts that joined Argent in that year and then had all Argent. They stayed with Argent long enough to have all Argent experience on their experience modification calculation. So in 2011, those are accounts that joined in 2011, eventually accumulated enough years with Argent to show that it's all Argent experience going into the mod, and the average mod change in that case was 13 points. So on average, we reduced our accounts by 13 points, and we helped a little more than 2/3 of our accounts in that year, or in those years. Class of 2012, again, dropping their mod by about 13 points. Class of 2013, helping that class drop about 9 points. 2014 was a good year. We were able to help our accounts cut their mod by over 19 points, almost 20 points. 2015 even better, almost 22 points cut out on average. And then taking all of that information and all those years combined, we typically are able to pull out 15 points on average for the accounts that we work with at West Bend and Argent. So this really brings it full circle. So these numbers show West Bend and Argent's ability to help accounts realize premium savings over the long term. And then there at the bottom too, by preventing claims from happening altogether with the help of your loss control representative, and then controlling them when they do happen with the help of your claims representative, our insureds are getting better premium savings as a result of a reduction in their experience modification factor. This is just a quick little look at loss ratios. We do have information for West Bend as a whole, as well as Argent, as far as outcomes go when it comes to loss ratios. And this is over a 5-year period, and I'll have you focus on the rightmost columns that are in the dark box there. So loss ratio, meaning the claims costs divided by the premium paid. So we consistently outperformed the industry is what we're trying to convey here. This table is organized in order of market share. So market share of work comp premium in Wisconsin. So Travelers writes the most work comp premium in Wisconsin in this case, whereas West Bend writes the second most premium, and so on and so forth. So again, you compare those numbers that we've been putting up over since 2014, and this is all collected from an independent third party, Aon Benfield. You may be familiar with them, but this information is released every year, and we've been monitoring this. But this is just trying to help explain the performance that we give our accounts is no accident. This is year after year that we're able to sustain those numbers. Again, this is specific to Wisconsin, and what this means then is that companies who partner with West Bend, they're going to realize lower loss ratios, and thus, one, better premium pricing, and secondarily, if they have a dividend on a variable dividend on their policy, they're going to have a higher payout on that dividend. And then we do have information specific to all states in Argent. This is a 5-year look back. So, and this is a little bit misleading. I mean, the numbers aren't misleading, but just the visual presentation of it, that, our loss ratios hover around that 40 to 45% mark year after year. Now, looking at that graph, it maxes out at 50%. I wish it maxed out at 100% to really kind of put things in perspective, but that doesn't change the fact that, again, we are helping our insureds. This is all states, all accounts, all industries, the averages that Argent puts up year over year, and it hovers right around that 40 to 45% mark. And even again here in 2020, obviously we're only partway through the year, but we're on track there again to post some pretty favorable numbers as well. So to wrap things up here, just to breeze back over kind of everything else that we did go through, we did go through the experience modification rating. I showed you the formula on how to calculate that. We went over some of the mod worksheets, including the unit stat information, how your mod impacts premium, as well as the significance of return to work and modified light duty programs to keep claims medical only, not letting them get to indemnity. And then the life cycle of an experience mod, as well as some of the different mod scenarios. So that concludes what I had for you folks this afternoon, and I did it all in under an hour, so that's outstanding. I will stick around here for a little while yet and go back through the chat and see if any other questions did come up, and I'll be available too for additional questions that you might have in the chat box. So Craig, you ask about, let's see, paying as vacation time. Am I understanding that if an employee takes PTO, for example, if they take their vacation time, in that case, that's on them. That's not counted against. If an employee chooses to take vacation or PTO or whatever you might call it, that's not indemnity. That's just on their own. But that's where the importance of getting a doctor's assessment of whether or not an employee can return to work. So employee gets injured, they go to the doctor, and they should take with them some documentation that you have available that you would have worked with your loss control representative or your claims representative on to explain for the doctor exactly what it is that you want them, explain what it is that you're looking for from the doctor. Can the employee return to work, yes or no? If so, how quickly? Is this they just take a day, or do they need to be out for 2 weeks? What is their physical capacity? Do they need to be laying down for the entire day, or can they be seated at least? Can they walk for 4 hours or be seated for 4 hours? I mean, finding ways to get the employee back to work essentially. But if that employee chooses to just take vacation or PTO, then that's up to them, but that's not, that wouldn't be factored into the claim or experience mod in this case. Any other questions? And you guys can follow up with Jason Schaffenbuhl as well. And then, of course, certainly feel free to get a hold of your claims representative or loss control representative as well. And I guess as long as I've got you here too, I think I can't stress enough that in some states, you can't simply just pay an employee to stay home either. That's called wage continuation. And again, it's dependent on each state, but your claims representative would be able to advise more clearly because they have expertise in that particular state. Well, regardless, thank you everybody again for joining us today. We enjoy having you as customers, and we value your partnership. Feel free to reach out to Jason Schaffenbuhl, your loss control reps, your claims reps with any questions, and we're happy to serve you. Thanks, everybody. Have a great rest of your day.